How effective is the Golden Cross? I looked at 25 years of data, over 3,700 trades to determine just how effective the 50 SMA crossing above the 200 SMA is. This is considered the Golden Cross. Stay tuned to the end, and I'm going to give a grade A, B, C, D, or F to this trading strategy. Let's dive into it. All right, so here's what we have on the agenda today. Welcome to Crossover to Profits. We're going to define the backtest setup. We're going to look at our trade environment, the conditions for entry, conditions for exit, our targets and stops, results, and we'll go look at some chart examples. We're going to optimize this trading strategy. And then at the end, stay tuned. I'll give a final grade of how effective this strategy is. So what is the backtest parameters? It's called the Golden Cross setup, which if you're not familiar is the 50-period SMA crossing above the 200 SMA. And this signals a bullish setup. So we're crossing from a shorter moving average above a longer term moving average, and allows you to get in right at the moment or towards the moment of bullish momentum, and then allows you to ride that wave throughout the life cycle of that bullish momentum. Trade environment. So what are we going to be looking at? What are the stocks in play? It's anything on the NYSE and the NASDAQ. We're looking at anything above a share price of $1. So remove all the penny stocks. And I'm looking at average volume greater than 500,000. So make sure there's enough liquidity in each one of these stocks that we're trading. And then I'm looking from beginning of 2000 all the way through current date, which is early August 2024. So great sample size, a lot of market ups and downs within that time horizon. And we're going to start with $100,000 of initial capital. What are our conditions for entry? We're going to be only looking at trades that the 50-period SMA crosses above the 200-period SMA. We're going to enter trades at the next day open. We're going to prioritize the trades based on the 2-period rate of change. So when we have multiple stocks that hit that 50 crossing above the 200 in a day, we're going to prioritize from the stocks that have the highest 2-day rate of change, and then we're going to risk 1% of our equity in each trade. Conditions for exit. This is going to be the 50 SMA crossing below the 200, and then we're going to exit at the next day open. Targets and stops for this initial back test, we're not going to have any target or stop. It's just going to be that 50 and 200 SMA giving us our signals to enter and exit. All right, so what did I use for the back test? I used market in and out, and then we're going to look at Finviz for some chart examples. So let's hop over to market in and out. I'll show you the back test results. And if you're not familiar, I'll give a quick walkthrough of that platform. Okay, I'm over at Market In and Out. This is a stock screener and backtesting website, and I found it to be the best website for running backtests. Really no coding required. It's a very nice, simple, clean interface that allows you to run backtest on a number of different technical indicators. So as I outlined here is the conditions, time period, initial capital, and then here are the results. It's total number of trades, profit percent, our annual average return is 6.42%, total profit of 200,000, which is capital growth of right around 200%. And then what's really great is this equity curve at the bottom showing the time horizon of our setup compared to the S&P. So you can see that we are outperforming the market until about early 2023, and then this strategy started to fall apart. So, and it does give it overall viability score of a 5 out of 10. So overall, pretty good setup. You can see some max drawdowns of 55%. So there's some big ups and downs with this trading strategy. And then it gives us nice performance graph here where you can see by month, by year of how the performance went. And then you can also look on a yearly basis how you compare to the S&P 500 under different trading strategies. So this is a really clean interface to be able to see some really good statistics. And then what's awesome is you can see the individual trades that made up this trading strategy. I'll tell you entry date, your entry price, your exit price, how many shares, and then your profit, and then what you exit on. And it shows just throughout the life of the trading window, and you can download an Excel that'll have every single trade listed. So really great tool. This is what I used to run the back test. So again, 6.42% average annual return, compounded annual growth rate of 4.52%. So let's take a look at some trades that met this criteria, and then we can just kind of walk through what makes it a good strategy or what makes it a bad strategy. So first one I'm going to pull up is Groupon, and you can see I have, this is Finviz here. I have the 50 SMA in blue, and then in orange is the 200. So we crossed here right after earnings, big move up. So again, we prioritize based on that 2-period rate of change. So some big moves is going to get us into stocks. And then we have just a lot of volatility. So big swings up and down, big gap down with earnings, but we would have still been in that position as the 50 was above the 200. And then it kind of went up and down, big pullback here. And then eventually we were able actually to capture this big price swing towards the end of the move. And then around May 20th, we would have exited that. So you're in this position for a better part of a half a year, from August 10th or so all the way to May 20th. Saw some massive ups and down swings, but overall you came out a winner, exited probably around that $17 mark, and you got in at about $9.46. So almost 100% move, but again, a lot of volatility in that movement. Let's look at some other examples. These would be some rather large losers. So we had this massive upturn in the beginning of 2024. This is on CDIO, and we would have gotten in basically at the peak. And then we had this massive sell-off, but you're still in the position because that 50 hasn't started to curl back below the 200 until about May. So this is the downside of it. You're going to get in maybe really late to the move, and then you just have all that downside before you actually exit based on the signal. Let's look at another example. Similar story here where we got in on the tail end of the swing on the upside, and it took the 50 SMA, continued to move up as the price went down, and then it kind of leveled off and then started curling down, and then we didn't exit until just a couple days ago with a pretty substantial loss. Let's look at some open positions under this trading strategy. So ASTS, this is been one of the biggest movers over the past couple months out of all stocks listed. You can see we would have got in probably with the middle part of the move, and then we've had all this momentum to the upside. There's been no big pullbacks or anything, so obviously we're still in it, and there's a massive gap between the 50 and the 200 now, so it'll take a lot of downward momentum for us to exit this. But the great side about this setup is we're going to capture all that upside, so we continue to ride this, and we can be in these trades for many months or even a year or two before the 50 slopes below the 200. So you can ride trends for a very long time and capture a lot of price movement. You're just going to be open to a lot of volatility. Let's look at another open position here under the strategy. So this is RCAT, similar to the ASTS example, one of the best movers for the past couple months, but you can see we've got, this one's a little bit different. This wasn't just straight vertical. We got in basically towards the high of this price move, big pullback. We would have seen some big red losses here. And then it started to curl back up, and we saw a massive jump leading up to earnings, slight pullback, but still very much positive profit on this, open profit. And we have a big gap now that's widening on the 50 and the 200. So time will tell of how this ends up, but right now this is a big winner, but it's an open position, and we're going to see a lot of volatility as the price moves around, and it just takes a while for that 50 and 200 to cross again. So those are just some examples, but let's go back to our market in and out, and let's see how we can go about optimizing this setup. So what we've identified is allows you to ride the trends for a long time, but also there's a lot of volatility in that. So let's go into edit strategy, and let's just put in some parameters here. So let's do a 2 ATR stop loss. Let's do a take profit of 10. So that's a 5-to-1 risk to reward. And then you just click the back test. It takes a couple minutes to to run. You can see the little dial up top that it's running, but overall it's pretty quick for as much detail as you get and as many stocks as the backtest is running on. Okay, our backtest ended there. You can see that similar results. Total profit went up slightly. The overall viability actually went down, and you can see we're still in the end underperforming the S&P 500. So that's, even with putting in some stop loss and take profit parameters, we're still not looking at a great setup whenever you compare it to just a buy and hold S&P 500 approach. So let's do one more change, and let's just basically keep in the stop loss. So let's define a loss parameter, but let's take out the take profit. So limit our downside, but do not limit our upside. So all I'm going to do is just remove that take profit ATR, and I'm going to rerun the back test. Okay, look at that results. So that more than doubled our capital growth and our profit. We've got an average annual return of almost 9% now. You can see we've consistently outperformed the S&P. Overall viability now 7 out of 10. So just that one small tweak of basically cutting our losses early on versus waiting for those two crossovers to happen again, it makes a big difference in your outcome. This is what makes backtesting so powerful, is just one small tweak to your setup can really make a big difference in your trading. So I'm going to say that's a great improvement, and this is a very viable strategy, especially for a passive swing trader. All right, let's go back to the presentation and walk through just some of our final takeaways here. Okay, so we optimized it. We looked at adding a stop loss, and we've looked at adding a take profit, 2 ATR stop loss, 10 ATR take profit. We determined that wasn't optimal. We removed that take profit to not limit our upside. We kept the stop loss in to limit our downside, and we saw that made a substantial improvement to the overall strategy. And so with that improvement, well, what would I grade this? I'm going to give it a B. This is a great trading strategy, especially for beginners. It's super easy to set up. Lets winners run. Low maintenance. You place a couple trades, and your average hold time is going to be several weeks to even months, and you don't have to worry about anything. And the strategy in the long run is going to outperform the S&P. So this is better than just a buy and hold approach, which is a little bit more incremental effort. The downside, big swings in open profits and losses. We saw that in some of the chart examples. We're looking at 50 and 200-day moving averages. They don't move very quickly from day to day, so you're going to see some massive open profit and losses that are going to change. So if you want to check your P&L every day, your account balance, you're going to see you're going to have some headaches, you're going to have some elation, but ultimately you just got to hold to the setup, because in the end it's a very viable strategy, especially when you pair it with that 2 ATR stop loss. So hope you found this helpful. Please consider liking and subscribing. Please leave me a comment in the comment box if there's any future backtests you would like me to run, walk through just some examples and run the numbers and give my take on it. Otherwise, thanks for watching, and God bless.